Well, good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. I also want to say good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, or Pacific Time Zones. And as always, we want to say good evening to any of you who are joining us from across the pond in parts of Europe or parts of the UK. And good early morning if any of you are joining us from parts of Asia or parts of Australia or New Zealand. Welcome to today's Introduction to PowerOptions presentation. Today we're going to discuss the portfolio tools. We're getting close to the standard June expiration. Of course, I realize many of you may be trading weekly options, whether they be spreads or covered calls or even naked puts on the weekly series. So you may have an expiration every week by week. But when we get close to the standard monthly expiration, we always want to showcase the portfolio tools to show how the PowerOptions portfolio can help you track, manage, analyze your positions, evaluate rollout opportunities or adjustments so you can see that we do all the heavy lifting for you. You still have to make the final decision, but at least you can see everything numerically and graphically in front of you before making a decision, and we're going to walk through that today. All right, first we want to begin with what is PowerOptions? Well, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zerrenner created the PowerOptions suite of tools over 15 years ago. He had been trading options for about 20 years before then, but he wanted a set of tools when he retired from Hewlett-Packard that would allow him to identify new positions in a given strategy based on his stock and option criteria. So in addition for screening for stock fundamentals and technicals, he also only wanted to see those positions that matched his return, downside protection, or risk threshold in a given spread or covered call position. Our patented search tool allows you to search across the universe of options in over 23 different common strategies, so you can identify just those ones that match your risk and reward tolerance. And then, of course, we have quick links to help you further research and analyze the position and compare the risk versus reward. And then, of course, the portfolio tools, which help us paper trade, track, and manage your positions. In addition to that, of course, we offer countless educational articles, help pages, and hours and hours of archived webinars to help you get familiar not only with the tools on the site, but also the various option strategies. Now, as I mentioned, we've been in business for over 15 years, but we have many more years of combined trading experience. Everyone here at staff, or on staff at PowerOptions, uses these tools to trade their personal account, myself included, so we have many more years of combined trading experience. Now, for those of you who don't know, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. I've had the great pleasure of working with Ernie Zerrenner and the PowerOptions staff for the past 10 years or so, over 10 years now. I handle a lot of the coaching sessions, education, and obviously the webinars. The coaching sessions are important. Any of you who are currently on a trial or subscribers to PowerOptions, you can sign up for one of those free coaching sessions at any time. You can just go directly from the Home tab, click on Free Coaching Session, and schedule a time that's available. And it's not a sales call. It's just essentially a 40 to 45-minute walkthrough of the tools on the site, or we'll answer any questions that you have about using a certain tool, how you can set up a search based on what kind of positions you're looking for in a given strategy, and what kind of analysis tools are available for you. I have co-authored 2 books on options investing with Ernie, and I am versed in all strategies on the site, but I always want to be upfront. There are certain strategies I've never traded in my account and never plan to, things such as naked calls, short straddles, short strangles, and iron butterflies. These positions just don't match my personal risk-reward tolerance. I don't like the risk-reward profile. Yes, they can be profitable if done correctly, but I don't want to take that chance. However, at any time, if you have questions about those, we'll be more than happy to answer them. All right, so what we're going to cover today is the functionality of the portfolio tools to help you track and manage your options positions. We're first going to start off with creating a new portfolio from scratch. And then we're going to talk about entering positions into the portfolio from the tools or manually entering your positions. We're going to talk about using the position analysis function, which is very important to help us analyze what are our rollout opportunities, my current liquidation value versus my future expiration value. And then we're going to use the simulate trade feature to help us analyze, what is this rollout, does this rollout opportunity match my specific requirements. And of course, we're also going to look at manual adjustments, setting up a manual adjustments using the profit and loss chart. Now, this presentation is designed to help you become more familiar with the PowerOptions portfolio, so that's what we're going to try to do today. Well, that being said, let's navigate over to the PowerOptions suite of tools. And what we're looking at right now is the basic form, or the basic page of a trial account. As you can see, the PowerOptions tools are designed as a tab navigation system. So we have the main home tab when you first log on. I mentioned this is where you can register for that free coaching session. In the Learning Center, of course, you can get to the webinars, the archived presentations, and a lot of the different help pages, white papers, for example, as well. And also follow along with the blog. Those books that I mentioned are available in the store. And if you need to make any changes to your user ID or, sorry, your email address, password, or so forth, you can just go into the My Account tab. Now, the second tab we're going to focus on mostly today, of course, is the My Portfolio tab. And if we click on My Portfolio, we'll see the main portfolio homepage. It gives us a description of what's available, how to start, so if we want to create a new portfolio from scratch, and of course you have the links to the various tools and the quick links right underneath the main tab. A real quick review, the profit and loss portfolio is where we track our open positions. The historical reports gives us a breakdown of all of our closed transactions, or if we just want to view the realized transactions or unrealized transactions, unrealized gain or loss, I should say, for positions that are not closed that you're tracking in your portfolio. And of course, you can look at them both together. The analysis view, this is one of my favorite views when I'm looking at a position that I've been rolling or adjusting historically. We'll take a look at that later on. Of course, the snapshot view just gives you a quick view of everything that you have in your position. There's also an allocation view, an alert summary we'll talk about, and of course the main setup page. Now, let's go into setup first. Here's what I'd like to do. If I'm going to create a new portfolio from scratch, whether it's I'm creating a portfolio to track or mirror my actual trading account, or if I'm just creating a paper trading portfolio, I want to start off by going in the My Portfolio tab, and then we're going to select Setup. Now, we do see that I have on our webinar account a variety of different positions, a variety of different webinars already created. One for radioactive trading, this Thinkorswim account. It's not a real account. It was just a sample that we did the last time we did this portfolio view, the portfolio presentation. We're tracking a variety of different covered calls and other positions as well to see how they'll perform over the course of the year. If this is your first time logging onto the account or going into the portfolio tools, I should say, you'd only have this choice here. Okay, so we just see this selection for new portfolio. And what we want to do is name our portfolio. So if this is just a paper trading account, I could call it paper trading covered calls, or paper trading puts, or paper trading strategies, paper trading spreads, for example. And then what I'd want to do is say, okay, I'm just going to use a paper trading account. I'm just going to throw some spreads in there, throw some positions in there, see how they perform over the next 30 days. But what I'd want to do is create a basic cash on hand and starting basis. All right, so if this was a paper trading account, but I was going to start off with a cash on hand, say, okay, let's start off with $50,000. So I'd put that into the cash on hand and copy that over to the starting basis. And if it's just a paper trading account, we could leave it the transaction date as today. Now, let's say, of course, that you have an actual trading account right now. Let's say that you have a Trade Monster account. So we'll just call this Trade Monster, account number, there we go. We'll just call it Trade Monster account 1798. Okay? Now, in your Trade Monster account, let's say that you have 5 or 6 different, let's be simple, 3 or 4 different covered call positions. We have an allocation of about $26,000 or so. But your total account value is at about, let's call it $35,000. So you've got $26,000 invested into covered call positions, 3 or 4 different covered calls maybe, and you've got $9,000 cash on hand looking for a new position. It's just sitting there. Okay? Well, the total amount, if I looked at my current Trade Monster portfolio, if I liquidated everything, I'd have an account value of $35,000. So that's what I'd want to start off with my cash on hand and my starting basis. Now, I did mention that I have $26,000 perhaps allocated to my portfolio and $9,000 in free capital. But if I'm trying to mirror my actual trading account, I want to start off with my total market value. So let's go ahead and save those changes. And now, of course, it just lists it here available for us. Here's our Trade Monster account 1798 in the setup view with our cash on hand and our cost basis. Now, what I'd want to do is start entering my positions manually. So the first thing I'll do is go to the profit and loss portfolios. this is the tool where we track our open positions. The system took me directly to the new account I just created, but again, if this is the only portfolio you had the first time you're setting it up, this would just be listed there for you. If you have multiple portfolios, as you can see, I can quickly scan to another existing portfolio. I could go to a previous portfolio or next, or more simply, I can use the drop-down menu if I wanted to go back now to the radioactive trading presentations, look at my Thinkorswim accounts, or look at the positions in any of the various webinar strategies. Okay. Now, entering a position manually. We mentioned that maybe we have 3 covered calls with a total cost base of about $26,000. So let's say my first position is, let's say originally I had bought shares of Johnson & Johnson at about $80 per share, and back in beginning of June or the end of May, I sold a June 82.5 call for maybe 80 cents. Okay, well I want to enter that position. So here, right here in the second view, we have the drop-down menu for enter a new position. Now, what do I have with a covered call? I have a long stock and I have a short call. A lot of new investors will enter it first. They'll put in a long stock. So let's do it that way. I'll put in a long stock first. And let's say we bought 200 shares of Johnson & Johnson at about $80 per share back on May 18th. All right, so I'll put in my stock symbol, J&J, my number of shares, 200, very simple. What did I say, 5/18? So let's just put May 18, oops, sorry folks, there we go, 2013. Now I'm going to treat this as just a paper trade, but if this is a real trade, well, let's do that. I'm going to put in a real commission of $5. I'll keep it simple. And I'll put in my price per share of $80. All right, so let me go ahead and add new position. All right, so now I have one part of my covered call entered. I'm showing you the wrong way to do it first and then show you the right way. So here we have a long stock position. My net cost, it gives me the description, Johnson & Johnson, 200 shares, transaction date of 5/18, the age. And this tells me I've been in the position for 32 days. When we look at an option, when I enter an option, we're going to see it's going to be a negative, it's going to be a number in parentheses. It's going to show me how many days left expiration. Now my net cost into the position was $16,005. Well, that was the $80 per share, my issue price, 200 shares, plus, remember, we put in a $5 commission. So that's accounted for in my total net cost for the positions I have entered. At the same time, okay, we see the stock's moved up $6.07. It's currently at 86.07. The effective cost per share we'll talk about in just a moment. Now today, when I see the price at 86.07, it also shows me the change today of 29 cents. That just tells me what we've done so far. Now I have a gain of 7.6%, but I have to remember that, oh, this isn't just a long stock position. I also have a short call. Okay, so I need to account for that. It's a covered call trade. So I can enter a short call into the position, into the portfolio, excuse me. So I'll select short call. I'm given a choice to select the option. Now it doesn't know which symbol I want if I'm just doing this as an individual option. So if you're entering just a long call or a long put, you'd still select that from the drop-down menu. But when you click on the chain to select the option, you'll have to put in the symbol. Okay, so we sold a June, we're going to simulate that we sold a June 82.5 call for, let's say, 80 cents sometime shortly after we bought the stock. So I have my different expirations here, June, July, August. I'm going to click the tile for June. That gives me an expanded chain. We're going to select the 82.5 call. All right, so that puts it in our description. We had 200 shares of stock, so we're going to sell 2 contracts. Let's say we actually sold this on 5/20, a couple days after we bought the stock. Commission fee, let's go ahead and call that $5 as well. And we'll put in our premium price of 80 cents. All right, very good. Let's add that new position. Oh, stock price at time of trade. Let's call that 81. Okay, so now I have a covered call position essentially. I can see that right now the gain or loss on my total portfolio is 1.8%. We've made $1,209 on the stock. We've lost $585 on the call. And as you can see, my cost basis, remember we started with that cash on hand and starting basis of $35,000. But as I added the cost of the stock, it took that down by the $16,005, but then it added in the premium of $160 from the, I'm sorry, $155 because it was $160 for the short call minus the $5 commission fee. So our total income so far is $155. Total net cost is $16,005 minus the $155. So now I have a remaining cash on hand of $19,000. And this is interesting. It shows me that the margin is required of $17,214. Well, what does that mean? I have a covered call. I shouldn't have any margin. Well, again, I mentioned that I was going to show you the way to enter it wrong before I showed you the way to enter it right. Okay, so what you want to do is if you're tracking a spread position, a covered call, anything with a combination, you don't want to enter it individually. And the reason why is because we want to track it as a linked position. So if I do have a stock position in my portfolio and I've converted it to a covered call, well, what I could do if I was just tracking the long stock is I could go to the position actions feature. This is where we could simulate, we're going to liquidate the position if we're selling to close it. We can edit the position. Sometimes you might enter in the wrong price or the wrong premium for a call, so you can edit it. If it's your paper trading portfolio and you were done after the first month and you just want to erase everything, you can just delete the position. And of course with Johnson & Johnson I can add dividends manually. We don't automatically assume that you got the dividend payment. You'd have to go in and add the dividends manually. And of course what I'd want to do now, if I had entered the stock first and just have a long stock position but it is actually a covered call, I want to add an option leg to the long stock position. That'll take us to the same form we saw before. Okay, we're going to select to sell. And now I have to select the option, but it's going to take me to a call or put because it doesn't know if I'm actually trying to do a short call or a short put. So it's the same setup, gives us the tiles for the different expirations. We sold an 82.5 call. I didn't have to enter in the stock symbol this time because it knew I was linking from Johnson & Johnson. We're going to put our date back at 5/20/2013, commission price of $5, and it's 80 cents premium. And of course I'll change my stock price at time of trade. It's not the current price. We want to put it what the stock was on 5/20. All right, so let's submit that. And now we have a different view. We're seeing the position as a linked position. I don't know about you and what portfolio or what broker you're using. One of my accounts, my retirement account essentially that I trade married puts, collars, and some other things with, is at Fidelity. And Fidelity is not fantastic about linking options positions, meaning when I look at my portfolio, I may see a listing for long stock of GNC, long stock of HTZ, one short call on HTZ, and then long stock on IMAX, and then a long put on HTZ, and then a short call on IMAX, and then a short call and a long put on GNC. So it's kind of mismatched. Well, one of the advantages of the PowerOptions Portfolio tools is we track the positions as a linked position. Now, I went about this the long way. I entered the long stock first, showed the wrong way of entering a short call. That's not how you want to track it. We want to have it as a linked position. So when I'm tracking a long stock, remember we went into position actions and we added an option leg. If this is actually a collar, I could put the long put in now. The reason why it's beneficial to track this as a linked position is now we see, okay, we have everything together. I have 3 days remaining to expiration on our short call. We have our description there for our one covered call position. I can see the change in price on the call and on my stock, side by side or top to bottom. And this gives me the gain or loss. So my total gain on the stock is $12.09. My loss on the call is $5.85. So it's going to cost me $585 more if I'm going to buy to close the call. One thing, two features that are available in the profit and loss portfolios, you can select to have your portfolios emailed to you daily. So just a summary of what your positions stand. You can select to have that emailed to you. And then there's another link here for view position analysis. And when you check that box, it adds 6 columns to the right-hand side. And the reason why this is important and also important to track it as a linked position is this shows me exactly where my covered call stands. So, okay, I can see that I've made $1,209 on the stock, but I'm giving $585 back due to the short call obligation at 85. The stock is at 86.07, so most likely I'm just going to let this get assigned and take my return. Well, what we're shown here is we're shown that information as a linked position. Remember, our total position cost would have been $15,850. My original expected gain, the max return for this covered call if I was assigned, was $650, or 4.1%, my invested capital. My current liquidation value would be $614. If I bought to close our short call, sold to close Johnson & Johnson, we'd taken $614 or 3.9%. Why is that? Well, there's still some time value, of course, remaining on this call. We have an 82.5 call, stock's at 86.07. So we're $3.57 intrinsic, we're $3.57 in the money, but the natural ask price, if we went to buy back this call now, the worst price we could get is $3.70, so that's sort of an extra 23 cents that we'd have to pay, and that's why we're looking at, 35 cents, 36 cents, so that's why we're looking at only a gain of 3.9% if we liquidate right now. However, the expiration value, this is showing me what I could expect. We're not making a projection. We're saying here if the stock stays at 86.07 for the next 3 days to expiration, we'd have that full gain we expected, almost the full gain, of 4.1%. Notice how the original expected gain or loss is $650 if we're assigned. Well, remember, the reason why we're only making $645 here at expiration if the stock stays above 82.5 is the system remembers that we'd still have to pay another $5 in commission on assignment, because that's the that's the commission we entered for the long stock, so it knows that if we're selling to close the long stock, we have to give $5 back. So we'd only make $645, but as the price of doing business, it's still a 4.1% gain on our invested capital. All right, so we've got that covered call entered. This short call that we put in, we realized we made a mistake. I'm not tracking a naked call. I didn't sell a naked call in Johnson & Johnson. That was an error in entering the position individually. So now I just want to remove it. So to remove all record of a position, use the More Information, the Edit More Info button again. We want to go to Position Actions. I just want to delete the position. I don't want to close it because then that might track a loss in my portfolio. I want to delete the entire record. That just takes us to an entry page to verify that we want to delete that short call position. So we'll click on Delete now. All right, now we're looking much better. We've got a covered call that will yield us 4.1%, and right now of our total portfolio value, we have a 1.8% gain. All right, now the correct way to enter a position, let's say we're tracking another covered call, and I'm just going to use HTZ as an example. It's one of the married puts I'm trading for the Fusion account at Radioactive Trading as a married put, but we're just going to simulate a covered call position. So let's say we entered a covered call on Hertz Global. We got into the stock in the beginning of June when it was trading right around $25 or so, and let's say we sold the June 25 call for 95 cents. Let's just call it 90 cents. All right, so when I go into Select Strategy, now I want to select Covered Call. I want to enter it as the linked position. If I'm doing a married put, doing a covered call, those of you trading spread positions, or if you're doing standard collars, for example, we want to enter that as a linked position from the beginning. So I'm going to enter this as a covered call. And it's going to, again, give me an entry field to put in my position. So I'm going to put an HTZ, and let's just do 100 shares this time. Let's say we got in at 6.1, commission fee of $5. Let's keep it the same. And our price per share, let's just call it $25.10. And at the same time, on June 1st, we sold the June 25 call. So again, we select our option. We go to the full chain. Now the system knows that since I selected a covered call, it's only going to show me the call strikes. So let's put in our 25 call, one contract, $5 commission fee. All right, and let's call it 95 cents. Okay, so now we have our information correct. Let's go ahead and add new position. And again, if I added the new position, it links to our profit and loss portfolio where we're now tracking two covered calls, both as linked positions. We can see the total expected gain or loss for both positions when selecting the view position analysis, the current liquidation, and the future expiration value. Okay, these are both profitable positions at this time, although they may want to be rolled. Johnson & Johnson, of course, up to 86.07, and Hertz is up to 25.58. Okay, now, if these are two real positions, I would have had other entries for each position. What I mean by that is I would have either mental stops or actual stops in my Trade Monster account or my trading account that I wanted to track. Okay? Anytime you enter a new position into the profit and loss portfolio, we have an alerts column here and a set alerts for the different positions. we just want to click on View. So next to HTZ, I'm going to click on View. And okay, so we bought the stock at 25.10. So if I had stop limits in mind that I wanted to be notified, or I might look to roll the position if Hertz dropped down to 24, or if it went above 25.50, we'll just put that in as an upper and lower limit. We can set limits for the option price as well. If I wanted to be notified if the option went gained in value or had a price that's more than double my initial entry price, what do we put in? 95 cents. So if I want it to be known if it raised up, to $1.90, or if it dropped down to 10 cents so I could buy it back and make 80% of what I wanted to. Of course, we already put a default in there for short options, whether you're doing a short put as a naked put or as a short call. If the option decreases by 80% in value, we automatically have an alert set for you. That doesn't mean you have to take any action. This is just following the 80-20 rule, which is common for investors to sell naked puts or covered calls. You know, if you've made 80% of what you expected to make, 80% or more of what you expected to make on the position before expiration, you may consider rolling it, taking that money off the table. In addition to that, of course, we could set in our days to expiration, but we see that on the portfolio anyway. And then, of course, we have position alerts where you can set the total position change. So if my covered call loses more than 5%, I may want to be notified of that as well. Now let's talk about some of the fundamental alerts. When I entered the covered call in, let's say, June 1st for Hertz, or when I entered the covered call on Johnson & Johnson, I most likely used the PowerOptions covered call search tool. And in addition to looking for criteria for finding covered calls that matched my requirements of at least a 3% return if assigned, maybe a 4% downside protection on stocks trading, let's say, you know, my stock price range of $5 to $85 per share. But I also may have looked for other things. You know, the covered call position, I may have looked for stocks that were trading above their 50-day moving average. Well, if that's something I used in my criteria on PowerOptions to identify a position, I'm also going to use it as an alert. So I identified positions that were in an uptrend trading above their 50-day moving average. So now I probably want to be notified if the stock drops below the 50-day moving average, if the trend adjusts. If you use Bollinger Bands for your screen, well, you might want to see if the stock drops below the lower Bollinger Band, or you know, goes above or below the upper Bollinger Band, the stock hits a new 52-week high or low. And one thing I always do with my positions, especially covered calls, I don't really trade covered calls that much anymore. I usually use standard collar positions or married puts. But I always want to be notified if I have a short call open, or any position really, if maybe I'm within 3 to 5 days to earnings. Now, I may want to look for an adjustment. If I'm tracking a covered call and I'm really, really positive and speculative on the earnings announcement, I may want to buy back that short call prior to the earnings date to give it a little bit more upside room. Of course, if more than likely I'm concerned about what happens if the stock moves against me and suffers a 20 or 30% drop, well, when I get notified that I'm in 3 days to earnings, I might look for an inexpensive 1-month out put just to hedge against the chance that the stock may drop 20 to 30%, even 15% overnight, where a stop loss wouldn't help me. And of course, if you're tracking a dividend-paying stock, as we were with Johnson & Johnson, I may want to know if I'm within 3 to 5 days to expiration. I am trading Johnson & Johnson as a married put as well, and I do have a short call open on it. But recently we crossed the next dividend date about a month ago or so, and I did have a short call against my married put position. Essentially had a collar, but when I had an 85 call, and the stock was wavering right at about 84.80, and I had 2 days to ex-dividend date. So even though I hadn't reached expiration for that call, I went ahead and bought back the 85 call because I didn't want to risk early assignment on the position. Actually, I rolled it to the next month and rolled it up in strike. So I'm holding a June 87.5 call on Johnson & Johnson right now. But I didn't want to risk getting assigned early because the dividend payment, I think, was 60 cents, and if the stock was still trading at 84.80 on ex-dividend, I probably would have been assigned early on that position. Okay? Well, once you make your changes to your alerts, you know, your upper and lower stock limit, upper limit or lower limit for your option bid price on this covered call, any of the technical criteria you wanted to set, and days until earnings or ex-dividend, then we'll go ahead and click Save. All right, so this will take us back to our profit and loss portfolio, and as we can see now on our HTZ covered call, we do have an alert triggered. Well, we can see this here because when we put our upper and lower stop limit into the position, it added that here for our fields for both the option and for the stock? Well, I put in a specifically put in a upper stop limit, at 2550 because we saw the stock was trading at 2558, and I wanted to show what happens when the alert is triggered. All right, so now that the alert's been triggered, I may check the alert first. I can see this one here, but we also have another one. Oh, okay, it didn't quite trigger it. It should have. I thought it would. I'm sorry, but the days remaining to expiration is 3 days. So it's less than, or it's not less than or equal to, it's just less than 3 days. So tomorrow that alert would come up because now I'm within 2 days to expiration. Okay, let's go back to the profit and loss portfolio. All right, so an alert has been triggered. Remember, we bought stock at 25.10. We sold the 25 call for 95 cents. Stock's now trading at 25.54, which is just above my upper stop limit of 25.50. And as we scroll over, because I checked the box again for view position analysis, I can see that, all right, I was expecting to make 3.1%, but right now, my liquidation value is only 1.8%. Ooh, that's not good. And the reason for that, of course, is twofold. Number one is that the market maker is, we're 50 cents in the money, 54 cents in the money, but the market maker is asking an additional 20 cents to buy back this call for 3 days at a time. That's annoying. But also, of course, the system knows that if I went to buy back the stock and buy back the call, I'm sorry, let me rephrase that, sell to close our stock, buy to close our call, we pay another $10 in commissions. So that's taken into account here on the liquidation loss. And then our expiration gain or loss, again, we're not projecting, where the stock's going to be. We're just saying if it stays at its current price for the next 3 days, we'll get assigned and make $70 or 2.9%. Again, why is it not $75? Because assignment is going to take into account the commission fee of having to sell to close the stock. So we're going to have to pay another commission of $5, and that would put us at 70. All right. Was that our only choices? No. But before we decide or evaluate any rollout opportunities, we do want to know what was our original expected gain, what is our current liquidation value, and what is our future expiration value if the stock stays at the same price. Well, an alert's been triggered. We're in a position, we have 3 days left to expiration. The stock's moved above our strike price. Okay. Okay, great question by Rick. Rick wants to know, he has a Thinkorswim as his broker. Can he set the commission structure to match, or is that an automatic? It's manual. Right now you have to enter the commissions manual for each trade, but what we are looking to do is the programmers are working on something for the portfolio where you could go into a sort of setup view or commission view, and you could set up in a given portfolio what your commissions would be for buying stock or closing stock, for selling calls, for assignments, for buying calls or buying puts. I pay a little bit more when I buy calls or when I buy puts as opposed to selling them in my Fidelity account. So that's that will be coming. Right now, Rick, it's manual each time you enter the position. Okay. All right, and if, of course, I know what you mean. There's sometimes when I may pay $5 to buy a stock and sell a call as my commission if I'm only doing 100 shares in one contract. But if I get assigned, it might only be a $2 commission fee, so that's a little bit different. Yeah, that's really cool, Rick. We're going to look to do that, and I'll let you know as soon as that's available. All right, so we've got our Hertz position, and we wanted to look at, well, what's possible now? Okay, so the way I want to do that is, again, from that More Information menu, we're going to go to Position Actions, and I want to go to Position Analysis. The analysis page, the position analysis page from a position in our portfolio is going to give us a breakdown of our current covered call. So up at the top, we have our original position that we entered on, what was that, June 1st. We see right now the current stock price at $25.54. The break-even for the position is $24.25. That's shown here on the profit and loss chart, is that magenta line, sort of. And the green line, of course, the current stock price. Current option ask is 75 cents. Ironically, that's the delta for our in-the-money call now. And our time value has dropped to 0.8%, and we have 3 days remaining to expiration. Now, right here, we could do some quick links if we wanted to look at some things such as the company news, the stock chart, take a look at the PowerOptions stock or option details page, and some other pages we link to with things such as bar chart, I believe, Zach's pages for the balance sheet, and so forth. So you could do further research right there. You're already in the position, so you've already done most of this, but if you wanted to review it, kind of where the position stands, what does it look like now, bullish or bearish, before you make your adjustment, that's available as well. All right, and when we scroll down, we see the three sort of calculations that we already saw in our profit and loss portfolio when we selected the view position analysis box. We have original position value was 24.25, 25.10 for the stock minus 95 for the call option. Our effective cost per share is the same, of course. It was only 100 shares. That's easy. And our max original expected return was 3.1%. Stock was trading above our strike price at expiration. You can click on the details there to see the calculations. And below that, we see our current liquidation value. If I sold to close my stock and bought to close our call, we'd have a cost basis of $24.6944. We're only 1.8% after 18 days, which isn't bad, but we were expecting 3.1. And of course, what's showing it here, this liquidation profit / expiration profit, this is showing us how much we've made if we liquidate right now versus how much we might make if we hold the position to expiration and the stock stays at the same price. Oh, Rick, I'll get to the what-if calculations in just a second. Actually, I'm going to do it twofold. We're going to leave this page, and I'm going to come back to it. Okay? All right, so as I scroll further down, I see where I stand right now. I can make 1.8% if we liquidate today, and then we could do the 2.9% if we hold the position to expiration and the stock stays above $25. Okay, we'd be assigned for the max return. All right. Now, down below, we see some rollout opportunities. Okay. All right, these are all good. That's okay. These are all good, but that's okay. But I was hoping we'd see an example that would match what I'm looking for. We might see one on Johnson & Johnson, but let me take a look. Here's what we're looking at. We know we can make 1.8% if we liquidate, or 2.9% if we hold it to expiration, the stock stays above 25. Okay, but right now, we are showing some of these rollout opportunities. We could buy to close our June 25 call for 75 cents. We'd only make 25 cents or 20 cents in profit. And we could go ahead and sell the July 25 call for $1.35. Now, my new adjusted net credit is $1.55. What does that mean? Well, that's taking into account the original 95 cents we received minus the 75-cent buyback cost. So that's we make 20 cents profit on our existing call, and then the new 135 premium. Okay, so all of that's taken into account with this adjusted net credit. Now, my new downside protection and my new percent return if assigned are based on this new adjusted net credit. So by rolling here, I could take my potential return 3 days from now from 2.9% up to 6.2%. And why is that important to see? Well, here's the rule. Remember, I spewed out some criteria I might have used when I was opening a covered call. Okay, stock within this price range, looking for stocks that are in an uptrend above the 50-day moving average. And at the same time, I perhaps maybe wanted to see, a downside protection of at least 3% and a percent if assigned of at least 3%. Okay, well, we're close to that here, the 2.9. But we see if this percent if assigned, if we roll out 1 month, we'll increase that from 2.9 to 6.2. So that's a 3.3% return for 31 days. That matches my goals. The reason why I'm pointing this out, we may take a look at this in a different covered call position, one of our other portfolios, is because you don't want to roll for the sake of rolling. And what I mean by that is that if I'm currently at a gain of, let's say, 3.3 or 3.4% on my covered call, whether it's the liquidation value or the expiration value, and I see an opportunity to roll to the next strike or the same strike 1 month out in time, but my gain only goes from 3.3% right now if I liquidate it or if I'm assigned to 4.5% over the next 30 days, this doesn't match my goal. If my goal in a covered call or naked put portfolio is to make at least 2 or 2.5% every 30 days, by rolling at this point, just going from 3.3% to 4.5%, I'm not matching my goals. So at that point, I'd probably just decide to let the position get assigned, take my 3.3%, and then the next day use the search tool, or that same day use the search tool to identify a new covered call that does match my criteria. Okay, so that's what we're looking at. Now, it's great to see things numerically. Let me clear this up for everyone. There we go. That's much better. It's great to see everything numerically, but let's face it, most of us that trade options, we like to see the profit and loss chart. We like to see comparison charts. No problem. As you link to the position analysis screen from one of the positions you're tracking in your portfolio, and you see some rollout opportunities available, well, I can click that More Information button, and we'll select Simulate Trade. Now, the simulate trade feature is a side-by-side comparison. Over on the left in red is my current covered call on HTZ, Hertz Global, stock at 25.10, sold the June 25 call for 95 cents. Our current return, it went up a little bit from where we saw in the portfolio. It's up to 2.2% now. I think it was 1.8. And then I've got a max return of 3.1% if we're assigned. And down below on our profit and loss chart, that's shown in red as well. So here's our hockey stick graph of my current covered call. Over on the right in blue is what the new position would look like if we bought to close our June 25 call and sold to open the July 25 call at 135. Okay, so we have a new cost basis now of $24.90. Our new total cost would drop from $24.25 to $23.60. This is reflecting the cost basis on the stock. And we could make that new return of 5.9%. Looks like the price has changed a little bit when we linked over, and that's okay. So we're still at about 6%. That's still matching our goals from where we are. And we increased the maximum monetary profit from $75 to $140. Let me add that back in. Okay, and that's our new covered call on HTZ. Now, is this a recommendation or suggestion of what you should do? No. We're giving you opportunities. We're doing the legwork for you, doing the calculations of what it would cost you to buy to close your existing call, what your position would look like if you sold this new call, and showing you the side-by-side comparison for your analysis. If I'm more bullish on HTZ going forward, moved up to $25.50, I can buy back the call now and make some profit, but I think the stock has the potential maybe to go up above 26 or 27. Well, instead of just rolling to the 25 call, I may be a little bit more speculative, sorry about that, there we go, and go to the July 26. All right, now this would be a lower net credit. I'm only going to receive 80 cents for the further out of the money call. Gives me an adjusted net credit of $1, so my downside protection is lower, but my potential return if assigned jumps up to 8%. And of course, we're showing you here what is the theoretical probability your stock would be above those strike prices in the next 30 or 90 days. Okay, so let's go ahead and do that. And we could simulate trade, and you'll see the same functionality. Over on the left in red, our original position price, and over on the right in blue is our new position. Of course, this one just gave us a little side-by-side view instead of an overlay. But we see that with a new potential return of 7.7%, but we need the stock to be moving up to 26. This is a little bit more speculative. Okay. All right, now before we get into, if I decided that this is the call I wanted to do, this is the adjustment I wanted to do, I could go ahead and submit change to portfolio right now. I'm not going to do that yet. Let me go back to the post-purchase analysis, and I'm going to address two things here real quick. Okay, first off, Rick says, I'm going to show Rick two things here. Let's see. Okay, sorry. Rick had mentioned, I noticed the future expiration amount and percent are in green. Let's go back and just show you that real quick. Okay, so here they are. Yes, they're in green. Would a loss show in red? Absolutely. We'll take a look at one of those. Remind me to do that a little bit later on. I'm going to look at one that's a loss, covered call in a loss. Let me jot that down. We'll go back in a second. Okay. Now, Rick's other question was, as we were viewing this field here that showed our profit and loss and our links, there's this what if calculations feature here. Okay, let's look at our rollout opportunities again. I'm showing opportunities to roll to July, which are 31 days out. Fantastic. Got some good returns there if I decided to do one of those rolls. And then it just shows me a listing of the September series, which are 94 days out. Well, there's no August shown, and there's no October. Okay, what if I wanted to roll further? Or is there a reason why the August didn't come up? Well, back here what I can do is the what if calculations. Let's go ahead and click on that. And what this does is it takes us to another tool on PowerOptions called the custom spread tool or the profit and loss chart. And it linked us over and it put in our exact position. So our stock at 25.10, short call at 95. Now, that's our original position price. You say, but wait a minute, I had commissions. Yes, you did. That's taken into account here. So your true cost basis was $25.15 for the stock, $90 for the call that you sold, because that $5 commission we entered for each side is being calculated. Max return, again, we saw that 3.1%. Okay, and we know that we could roll. We saw, another way to look at this, we saw the July 25 call, and we saw the July 26 call in the rollout opportunities. We didn't see any August calls. Okay, So let's go manually. We went into the profit and loss chart, the custom spread tool here with that what if calculations link. But now I can click on view options. And I see, okay, well this is the reason why. There just aren't any August options available. Yet, there will be Monday morning after June expiration, so I don't have the August choice. I could roll out to December if I wanted to go really far out in time. But another question you might have is, what would happen if I'm more, we saw the rolling up to the 20, or rolling to the same strike, the 25, or rolling up to the 26 on HTZ in the rollout opportunities. But what if I'm a little concerned about the market? And I like this position, maybe I want to stay in it long term, but I want to hedge the potential against loss. What would happen if I sold the July 24 call that's more in the money right now? How would that look on my position? Now, you have to remember here that my original, our liquidation value right now, we knew that from looking before. I always want to keep that in mind. We could liquidate right now for about a 1.8 or an increase to almost a 2% gain, or we had a 2.9% gain including commissions at expiration if the stock stayed above 25. So let's just put EXP here. Okay, that's expiration, and this is LIQ, liquidation. Okay, so I want to keep that in mind. But what do I have to do here manually? Well, I have to simulate buying to close my June 25 call and then selling to open a July 24 to be a little bit more protective. Okay, so let's do that first. I'm going to go to June. I'm going to click the tags here over on the left, and this pulls up the full call and put chain for HTZ. Now I see that the 25 call has already been added, and that's okay. I'm going to click it again, and that adds it into the third block. And we see a bid of 65 and an ask of 75 for this, this manual position. This is the custom spread tool. So I need to buy one June 25 call. Let's use some midpoint pricing. I'll just put it in at 70 cents instead of 75. Now, what does this show? It shows that I have stock at 25.10, sold a June 25 call for 95, and bought a June 25 call for 70 cents. Well, this looks like 3 different transactions, and it is. But when we submit that, the profit and loss chart now shows us just a stock position with a cost basis of $24.85 from the original price of $25.10 minus the $25 that we kept for that position. So we have a new cost basis of $24.85. This is what your position would look like. If you just bought to close the call, you'd now have an effective cost per share of $24.85 on your stock, and you just have a long stock position. Okay, but now we need to simulate selling the July call against it. My original premium I received is already taken into account. My buyback cost is already taken into account. So now we just go to view options again, and I'm going to simulate selling a July 24 call is what I said, right? Yeah, 24 call at 205. Okay, so let's simulate that. Okay, so it adds that in for me. It shows me it's been added, puts it in the next available block. We're going to sell one, and I'm just going to leave it alone now. And if I leave the position blank and I hit submit, it's going to go ahead and grab the natural bid price if I'm selling at 205, and it would grab the natural ask price if I'm buying. Now we see that our new return would be 5% if the stock's trading above $27 at July expiration. Okay. Now remember, we knew what our liquidation value was 1.8. Current liquidation was about 2.9. I'm sorry. Future expiration, if we got assigned in the next 3 days, was 2.9, or about 3%. Now, why is that important? Because again, if my guidelines, even though I'm trying to hedge this a little bit, my guidelines for return for a 30-day trade, if I'm doing covered calls in my portfolio or naked puts, if that's my goal is to make 2.5% or more, this doesn't match that. Yes, it's defensive. I've lowered my cost basis more down to $22.80. I've greatly increased my break-even as well, down about $23.55. But is this worth it to me? Does this match my goals? Well, 2% would still be okay with a little bit of protection. Move from 3% potentially this week to 5% 30 days from now. But this is why you want to always analyze, is it worth it to roll for the sake of rolling? Is this matching your goals? Okay. Now this is better shown if we have a loss on a covered call. We'll take a look at that in just a moment. Now you will notice something here, and I'll explain this. Excuse me. This looks like a weird covered call chart, doesn't it? It's kind of skewed. It's curved. Why is it curved? Well, it's because the system it does calculate that this is closed out monetarily, and this would be our return if the stock was trading above 27 now at July expiration. But the reason why we see a curve is it kind of is reading this as a calendar spread. It's reading it as we're short a June 25 call, long a June 25 call, and short a July 24 call. Sometimes an easier way to do this is we know here if we bought back or closed our position that we simulated and saw the long stock position, we bought it back for 25 cents. I'm sorry, we bought it back and made 25 cents. And let's account for commission. So let's say that was just a $5 commission, so we still would have kept 20 cents from that transaction of selling the call and buying it back. Well, I know that I could reduce my cost basis of my stock down from $25.10 to $24.90. And I've got $205 there if I rolled now to the July 24 call. My previous transactions already counted monetarily by me lowering the cost basis of the stock. So let's submit that. And there you go. Same view. It's 5%. And that's more of a covered call because it's not skewing it based on those different ones. Oh, no, Rick. This is one of the reasons why I mentioned earlier. Okay, here's Rick's new comment. It shows max risk as full cost of the stock. Isn't there protection with the call? Yeah, a protection of 3, 4, 5%. That's it. Now, what this is showing you, Rick, is you have a cost basis on your stock of $2,490. We just simulated rolling that, adjusting our cost basis, and selling a call at 205. So my total cost basis now into the Hertz position would be $22.85. I am risking 100% of that cost basis at $22.85. Now, I know what you're thinking. You're thinking, oh, well, if I had bought stock at $24.90 and sold the call for $205, I'm only risking $22.85, which is only about 95% of my $24.90. You're right. But what this is showing is your total cost, including stock price, minus call premium, and the max risk is 100%. If HTZ goes bankrupt tomorrow, if I have a stop loss, that's violated. That's gone. Excuse me. So that I'm sorry. If I have a stop loss, that's gone. I still suffer a loss of $2,285. Yeah, my call expires, worthless, but I have a stock that my total cost was $22.85, now trading at 0. So a covered call, you're risking 100% of the investment if the stock moves against you. Okay. All right. Now. And that's why we do married put and radioactive trading. That's right. But that's also, Rick, why I do standard collars. So let's take another view. We were concerned about HTZ dropping, so we lowered the cost basis of our position. Instead of doing what was shown on the rollout opportunities, we manually did an adjustment here to roll down to the 24 call. But let's say I'm still hesitant. I don't like the potential news that the Fed might come out with in the next couple of days. I'm concerned that HTZ might actually drop to $22 or $21 per share. Maybe I want to hedge that a little bit. What could I do? Well, this is where the standard collar comes in for those of you trading covered calls. I'll go back into view options and I'll go to July. And we have our calls. We rolled to the 24 call. We know that. But let me see something cheap here. Let me go with the 23 put. Yeah, I'm going to go with the 23 put for 30 cents. I'm going to add that in. I'm going to buy that. Not for 35. We'll do the natural ask. We'll buy that as well. So sometimes it's okay to just do a 1-month trade with protection. I really like this. Okay, so remember, we had a potential to make 5%. Let's just consider this a 1-month trade instead of a roll. All right, so we had a potential to make 5% on our position. Well, now if we sell that deeper in the money 24 call for 205 and buy a put for 35 cents, we're going to lower our gain from 5% to 3.4. But again, in the worst case scenario, the most we could lose is, oh, that's terrible. Hold on. Sorry, the most we could lose is $20 or 0.9%, even if the stock dropped to $18 per share or $17 per share. That's why I use standard collars from time to time. If this was an original covered call I saw that could make 5%, but if I add the collar to it, and it still keeps me above that 2.5%, 2.8% gain I'm looking for and limits my loss to less than 0.9%, I'm happy with that as a 30-day trade. Okay, that's perfectly fine for me. All right, so that's just your standard collar. It's not radioactive because radioactive I'd be using a put that was further out in time and at a higher strike price. But a lot of times I use these standard collars in my positions. You know, have a similar risk-reward profile to your bull put credit spread or your bull call debit spread. But if I'm already long stock and I want to protect it, or a lot of times if I'm running a search or I see a good something in the news that looks like it has a good covered call premium that's not too much implied volatility but enough that looks like a good covered call return, I'll take that and analyze it as a collar, and I do run my own search for collars as well. All right, let's go back to the profit and loss portfolio. So there's two things I wanted to show you here. as we're looking at the position analysis, the what-if calculations takes you to that profit and loss page. So let's say you're looking at the position analysis, you're evaluating the rollout opportunities, and you don't see one you want. Or maybe you don't see any rollout opportunities at all because the stock's stagnated, hasn't really moved. Well, that's when you'd use that what-if calculations link to say, oh, but I was really planning on rolling. I really want to see what would happen if I rolled to this call or the next call. That's what that would do for you. You could use that what-if calculations. By the way, if you knew right away that, oh yeah, Hertz has moved up, but I still like it, I want to stay with the 25 call, I want to roll it to July. If you already thought you knew which call you wanted to roll to and you just wanted to analyze it, well, at this point, you could go to the position analysis, but if you already know which call you're planning on evaluating, you can link directly to that profit and loss chart we were right at from the position actions menu and run your own manual adjustment. All right, well, let's say we did want to do that. I'm going to go back to the position analysis view, just as we did before. Let's say we wanted to keep the June 25. I'm sorry, we want to roll the July 25. Okay, so we scroll down. We looked at the July 25. Hey, that still matches my goals. Go to Simulate Trade. See the side-by-side comparison. Decide I wanted to do this. And now I'm going to roll. So I'm going to buy to close my June 25 call for 75 cents. And we're going to sell to open the July 25 call for the natural bid at 135. It's going to cost me $5. Let's say that my broker charges me $5 to buy to close this call I already sold, but is only going to charge me $1.50 for the new one. Okay, so I'll just put that in. And then I'm going to submit change to portfolio down here at the bottom. That does all the legwork for me. I could do a manual roll. So let me just show this first. Sorry, getting ahead of myself. Here we are at Hertz. Stock at 25.10. And now we're holding the July 25 call for 135. But we see our effective cost per share. It's not a great example. But our effective, because of the commissions, but our effective cost per share has dropped. So since we did make, after commissions, 10 cents from that original call, and we lowered our, every time you track an adjustment, whether you're rolling a put that you're using as a protective put, you're selling a call and buying it back, a call expires worthless, for example, your effective cost per share will change in your portfolio. So as you keep rolling, as we go now to the position analysis or the profit and loss chart, let's go back to the position analysis. The cost basis, when you're looking at the profit and loss chart of the position analysis, will change to what your effective cost per share is. So you have a running tabulation and an accurate account when you're evaluating your rollout opportunities or simulating your rollout opportunities manually on the profit and loss chart based on the closed positions, what your new monetary cost per share would be on a covered call, married put, standard collar position, and so forth. Okay. Let me switch gears real quick. I think it's in the Thinkorswim account. Nope. Let's go to covered calls here. We might as well stick with covered calls for the time being. Let's load this up. Perfect. Perfect, perfect. Are both perfect? No, just this one. Okay. Here's one. Uh-oh, alert's been triggered. Stock's below 55.50. We originally bought LLY on April 22nd at 57.60. Because we rolled calls, got a cost basis of 56.17. We'd sold a 55 call for 91 cents. And that's not taken into account yet because it's not closed. So really our cost base is probably closer to 55.27. Okay? But the stock's trading at 51.97. So this position is a loss. Now to answer Rick's other question, our alert's been triggered. It's trading well below our lower stop limit. Let's go to position analysis. Okay. So here we are, 56.17. Oof. Bad position. It keeps declining in price on us. This original covered call, by the way, why is it showing a 0% return or just no gain or no loss or loss of $26? It's because we had to roll it down the first time because the stock declined in price. And we had to roll it again as the stock continued to go down. It looks like we're going to have to roll it again or abandon ship. So here you go, Rick. Here we see our current liquidation value, a loss of $331 in red or minus 6% after 49 days. Better position to be trading as a collar over time or especially as a married put. And the liquidation value is not much, I'm sorry, the future expiration value in the next 3 days is not much different because we essentially have no time value left. There's only an ask of 2 cents, so we've essentially evaporated the entire premium of this out-of-the-money call. Now, here's the debate. I had mentioned earlier that don't roll for the sake of rolling if it doesn't match your goals. Well, now we almost have to think in reverse, don't we? here's our rollout opportunities. We currently have a loss of 6%, and that is including the other covered calls that we've sold that already expired worthless. So we have a loss of okay, that's supposed to be a minus sign, not slashing through the 6. We have a loss of 6%. So if I buy to close my call at June 55, I'd probably just let this expire at this point if I was going to stay in the position rather than pay a commission for 2 cents, but let's ignore that. Buy to close the call for 2 cents, and I could sell to open the deep in the money July 50 call for 256. Now I get a positive net credit. We have a decent downside protection, but a 5.2% if assigned. Okay, now remember the stock's trading about 51. So this doesn't match my goal at all because there's no profit, but I've only reduced my loss right now by 0.8%. And I've got a 73% chance the stock might stay above 50 and get assigned. We could roll to the July 52.5 call, and that's priced at $1.92. I'm sorry, $1.03. So this reduces our loss from 6% down to 3.2%. Okay, that might not be too bad. And the reason why I say that is it's not a positive gain, but at least by rolling down here, if we do get assigned at 52.5, which is a possibility, stock's pulled down to 51, it might pull back up to 52. But we've taken our loss from 6% down to 3.2%. To me, that's a 2.8% positive gain. So that does match my goals. I'm minimizing loss, but this at least does match my goals here. I still have a reasonable downside protection. Of course, if you're looking for a positive gain, there's still low probability, but we could roll all the way out to the August 55 call. But this isn't telling you that it's a positive gain because of the premium. This is a positive gain of 0.6% if you're assigned at 55, so you still keep $4. See, the problem with rolling down to 50, remember our cost base is still up in the $56, $55 range. So letting us get assigned at 50, that's where that $5 loss and that big negative percent if assigned is coming into play. So here's a position at a loss, and now, again, this isn't a recommendation or suggestion. You have to decide if you want to try to mitigate your loss based on your expectation of the stock going forward to maybe just 0.8% and just have a probability of getting assigned and taking that 5% loss instead of the 6% loss. Or maybe if you think the stock's going to recover, the 52.5 would only result in a 3.2% loss. Of course, that doesn't mean that's the end of the story. As you approach July expiration, you could roll up maybe to the August 55, maybe keep trading it. But you're forcing yourself to manage this because the stock has dropped, what was that, 12%? Yeah, wrong portfolio. Sorry, folks. Why does it keep going? I'm sorry, folks. There we go. 9%. It's a 9.8% decline in price in the stock. We've only been able to hedge it with 2 calls by 3% or so, 3.8%. So that's why we're at a 6% loss in the position. And let's go back here. As I mentioned earlier, in the history, this is a great thing about the position action as well. We can see it here on the position analysis screen. Here's my history. We had sold the May 57.5 call for $1.50 because it's only 100 shares. And we ended up essentially buying it back to 7 to roll down. So we did make $143 on our first call, 95% of what we sold it for, but that doesn't counter the $563 loss we've taken on the stock. We're going to make $89 or more on our existing short call, but those two combined don't counter this loss. We're still at a 5.76% loss for the position. All right. Okay. Now, with all those tools in mind, yes, they're very powerful. Evaluating our rollout opportunities, closing the position, we could choose to liquidate it right now. I mentioned the analysis. Let's go to the analysis. So we see here are the closed positions. The positions that are high this analysis view, the reason why I like this, I should have gone the first one. Let's go to historical reports. As I mentioned, the historical reports give you a breakdown of your positions, both unrealized and realized gain or loss. So you can see a calculation total for that portfolio. We're looking just in 2013, but we could look in different years as we track positions over and over time. Okay, but just for 2013, this portfolio is up 5.3%, looking at all positions, realized or unrealized. Okay, but you see here that it's based on the entry date. All right, so I have a short call in WY, and okay, the stock. I have the IMAX position and stock here. Most of these are very simple. Here's another IMAX one. It's not linked with these. Here's Navistar. Oh, and then here's another IMAX call. Okay, so it's not linked together. It's linked by actual transaction date, not by stock. And that's why I personally prefer looking at the analysis view because it shows me everything by stock. What's shown in red here, this DDD position, that means it's an open position. Those highlighted in red are open positions in my portfolio. Those with a white background, such as HLF, well, this is a closed covered call that was assigned for a 3.8% gain. IMAX, rolled the call a couple times, ended up losing on the stock, but ended up getting assigned eventually. So we had 3 rolls, we were in it for 106 days and had a 4.7% return. All right, so we had to manage that position as it fell. LLY we just saw. Right, there's our historical view. We had the gain of $143 on the call, $89 right now on the call that's open, and a loss of $563 on the stock. MPL, hey, that was a great return, 8.3% covered call position that got assigned, as was Navistar at 3.3 and WY at 3.2. Now the total gain and loss for all these positions, when you tabulate it up, this is this is a standard covered call portfolio. This is actually a really good view. Since 2013, just looking at some of these positions, okay, it's not that active, but we have 1, 2, 3, 4, 5, 6, 7 covered call positions that we've entered. Of those 7 positions, we've been right and got assigned for the maximum gain on 5 of them, all right, 5 out of 7, and 1 of them we had to manage, but we still had a profit. So we have a profit on 6 out of 7 covered calls, okay? And when we average, it looks like on the ones we gained 2.3, 3.8, 4.7, 8.3, 3.3. So I'm going to call, and 3.2, I'm going to call that an average gain of close to about 3.5% when we're right. But notice that our overall return is only 1.6%, and that's due to 1 loss. The way the math works, if we have 7 successful gains and we have 1 loss of maybe 5, 8, 7%, and we're capping our gains to only 3%, 3.5%. Over time, that's the sorting aspect of the covered call. Actually, it's 10% loss here, but we've countered that with some calls, thankfully. But that's what it shows us, is that still, although we're averaging 3.4, 3.5% or more on our successful covered call trades, the 1 loss takes us down to where we're only showing a 1.6% gain over over 2013 for this covered call position. And as a counter, let's go to the radioactive trading webinar, which typically reflects my actual trades on the positions in Fusion, I should say. And using the married put, well, we're up 5.7% over the same time period, essentially. And Johnson & Johnson, you can see here. Oh, I'm sorry, in the history, here's a good example. When we add the dividend, it shows there in our calculations for Johnson & Johnson as well. So that's just one thing that we were looking at there, this covered calls portfolio. That's the risk of the sorting machine. You can be right 80 to 90% of the time, but if you're capping your gains short and you're allowing some of your losers to roll against you, even though you're trying to manage it, you can greatly reduce your expected return on the entire portfolio. Rick, excellent point. Seems now it's gone for you in credit spreads. Credit spreads are more pronounced. I mean, that leverage return of 10, 12, 15% on a bull put or bear call credit spread looks fantastic. But what you have to remember is that if I'm going out of the money looking for an 85 or 80% probability of the position expiring, I'm taking in 50 cents and I'm risking 5. Well, that's a 10 to 1 risk-reward ratio. Most investors, and I know you do the same, Rick, we've talked before, you're not going to allow yourself to take a full loss on that spread position. You're going to manage it. But even if I close it for 40% of the max loss or 50%, I had a 50-cent net credit, and as the stock moves against me, I liquidate that spread and have a loss, pay $2.50, so I have a loss of $2. Well, that just wiped out 4 previous trades. In general, if you're using a whole credit portfolio just of credit spreads, you're going to find over time you need to be right 90 to 95% of the time in order to make a reasonable profit. You need to be right about 85% of the time just to realize a profit. And that's not even taking into account if you take a full loss on one of those spreads. That's talking about even with management and maybe paying back 3, 4 times what you received as a credit that wiped out 3 or 4 previous trades. You're looking about an 85% probability of success in order to be profitable, and 90 to 95% probability of success to be profitable at a reasonable profit anywhere near your expectation of making that 10 to 15 to 20% leverage return over the course of the year. That's just been my experience, and it's not just my experience, it's been a lot of others investors' experiences as well. Okay, real quick, I'm going to go to the snapshot view. Now the snapshot view just shows you, so we're looking at that covered calls portfolio. We had the loss on LLY and we had the 3D systems position. What the snapshot view just shows you is real quick what are the gain and losses of your open position that you're tracking in your portfolio. Let's go to that radioactive trading one that had many more positions in it. So it just shows me what is the gain or loss on the positions I have on HTZ. IMAX, IMAX is up, but the put's unchanged from today. Johnson & Johnson, stocks down, calls down, puts unchanged, and so forth. Okay. The allocation view, it's pretty straightforward. Pie charts of this allocation by investment, industrial services, healthcare, technology, and so forth, and then asset allocation by industry by industry as well. And we could look at position value, and just change that a little bit. And then, of course, we could also look at number of positions. And that just gives us a brief allocation. Services is the highest, it looks like, in this particular portfolio, and it gives you a breakdown here as well. The first thing I do, by the way, in my actual trading account, not the webinar account, but in my actual PowerOptions account, where I have my Fidelity portfolios open, my Options Express portfolio, and so forth, I'm tracking my actual trades, which the Fidelity one mirrors what we just saw in the radioactive trading position. When I first log on to PowerOptions in the morning, right after 9:30, 9:35 or so, the first thing I do is I go to Alert Summary. So for each of my positions, whether it was in the Webinars Covered Calls portfolio that we looked at, the Married Puts portfolio, the Radioactive Trading portfolio, or the new one we just created, that Trade Monster one, when I set the alerts, when I go to the Alert Summary in the morning, it shows me if an alert's been triggered in any position, any of the alerts I've set across any of my portfolios. So that's where I start my day. And I say, oh, the alert for HTZ, it's at 2560, it's above 2550. So I'll click on that, and it'll take me to that particular trade, that particular portfolio. And I say, yep, that's triggered. Let me go to position actions and position analysis. And I can go back and look at the other alerts for the other positions and see those. Rick, I do apologize for that, but you're absolutely right. Rick says, but when the other gurus talk about covered calls or credit spreads and how you can make money even if you are wrong, it sounds like you'll make easy money. And that's what they're selling you on. And I'll admit, Kurt for Radioactive Trading and myself, we're selling a product as well. We're selling a product on using the radioactive trading techniques, the blueprint, which you've seen before. And, that's our product to sell, but we're selling it, telling everyone up front, we're not making any promises of what you could return per month. What we promise is that those who have gone through the covered call gurus, the paying $3,000 to learn how to trade covered call or spread positions, pay $3,000, take 2 days, you'll become a master at spread trading and covered calls. Not really. How many of those covered call gurus or those spread trading gurus and charge you $2,500 to $3,000 for a weekend seminar to teach you to become a master in 2 days? Strategies, I'll be honest with you, I haven't exactly mastered in 10 years. How they expect you to do that. But at the same time, you want to see a track record up front, because we know of a couple of these covered call gurus that do that, and they sell the weekend seminars, and they tell you, hey, you don't worry if the stock goes down. Yes, I do. I'm in this to grow my account. Let's go back real quick to covered calls. Let's look at, was that the one that had LOI in it? Yeah. Well, let's look at this. My original cost basis in the entire position, even after the roll, was $55.69. And if I liquidate right now, I'm taking a loss, if I liquidate right now, I'm taking a loss of $482 or 8.5%. Well, we're probably going to end up rolling this position again to manage it, but it's still going to be a loss of maybe $400 even after a third roll. How is this growing my portfolio? I absolutely care. If I'm only generating 2 to 3% per month with call premium, that's to say, oh, if the stock drops, you don't care. You're always going to gain 2 to 3% per month by selling calls against it. If my stock dropped 12%, that's 12% less in my portfolio. That's now 4 months I have to spend, 4 to 6 months, generating 2 to 3% just to get back to break even, not even a profit. How is this growing my account long term? The covered call can act as a sorting machine, and a lot of these, a couple of these gurus, I know off the top of my head, 4 or 5 years ago said, oh, we're going to show you how great this is. We're going to track a portfolio of $100,000, and we're going to turn it into $1 million in 4 years doing covered call positions. That portfolio magically disappeared after 4 months. It was nowhere to be found on their website. It just evaporated. No questions were answered from subscribers to that service whatsoever. It just disappeared. Well, if they can't make it work, why should you spend $3,000 for them to teach you in 2 days how they still can't make it work? They don't address the downside. I mean, that's the problem. So a lot of those places, there are great services out there that do good services for selecting or for managing spread trades, for example. I've seen some of those. More elaborate positions such as double diagonals and things of that nature, which I don't personally do. Oh, but you're renting stock. Stocks don't go down that often. You'll make so much money. It's easy. Yeah, it's a lot like renting a house, isn't it? You own the house, and you're going to rent it out, and someone who's renting it out from you is paying for it. But let me ask you this. If you're in the real estate business and you own a house and you're renting it out to someone, can you legally do that without having insurance on the house, or would you even consider doing that without having insurance on the house? That's what they're not telling you. Okay, that's what they're not telling you is that, yeah, you want insurance. You want insurance in the worst case scenario because if I entered 10 covered call trades and made 3% on each, and one of my covered call trades was higher volatility, looked like a 5% return, had earnings come out and it dropped 20%, let's call it 25%. I was right 9 out of 10 times. I was right 90% of the time, and I had that one that dropped 25%, and that put me right at break even for the month. That's not getting ahead. At least you didn't lose too much, and that's an extreme example. But how often are you right 90% of the time you're going to get a sign to make 3%? A lot of those you're going to have a 1% loss on, or just a 1% gain because it dropped below the call strike price. You're not going to make the full 3% and so forth. Okay, he says, I'm sorry, Rick just says one thing. Have you been talking to the company that sold me the accelerated wealth program that I'm still paying for 3 years later? They talked about renting property also. No, I'm not talking about them. I'm talking about any of the 5 or 6 covered call gurus I've come across in the past 10 years. One of them, who has disappeared completely from the internet about 1.5 years ago. He had a successful service. He was kind of a competitor of ours. I've met him in person, really nice guy. But out of the blue, about 1.5 years ago, his website just stopped. It was not there. He had about he probably had about 200 to 300 subscribers who were using some of his tools to find covered calls and spread trades, and they just went in on the morning, the site wasn't there. He was not there. No one was answering emails, phone number was disconnected, disappeared. The other ones I'm talking about, of course, are more along the lines of, I'm not going to say names, but, that sell these weekend seminars, and a lot of people get into trouble that way. And this isn't just, I'm not trying to bash other services. Please don't misunderstand that. We actually worked with a couple of these covered call gurus at the beginning, and I had to teach their users how to use PowerOptions. And the funny thing for me was I'd have these customers call up that were doing covered call portfolios, and they'd say, okay, well, I am making some returns that they promised, but I'm not getting ahead. How can I better protect my position? And I'd say, okay, well, if you have a covered call and you want to protect it to limit losses and you're getting your stop losses violated, the answer is to buy a put, turn it into a collar. Oh, no, I don't want to do that. I don't want to pay money to protect my position. What they're actually asking me is, what magical way have I not learned yet that I can own stock, rent it out selling a call, and generate more premium and increase my insurance? Well, that doesn't work that way. All right, if you sell more puts, well, now you're going to increase your risk to the downside. If you sell more calls than stock you own, now you've got infinite risk to the upside because you've got a naked call. Not everything's covered. So the only way to truly protect that in those situations is to turn covered calls into that standard collar position we were looking at earlier. Or longer-term growth that's worked for me for the last 4 years is doing that married put position with the different income methods. And as we saw, the covered call portfolio we've been tracking since the beginning of 2013, doing standard management, that was only about a 1.6% return, whereas the married put portfolio we're tracking since 2013 was showing closer to a 7% return. And that's pretty close to what my actual portfolio is. After 6 months in, I'm at about 7% gain, which is right on par for the past 2 or 3 years. My radioactive trades have been my portfolio has been averaging about a 12%, 12.5% gain over the last 3 years using the married put techniques. Last year, we did the same thing. We were tracking a covered call portfolio in the webinars versus married puts versus collars versus credit spreads, and we entered the same positions. 2 of the positions had one position had a 40% loss, one position had a 50% loss. After 12 months, because of those positions, the covered call portfolio ended up with a 1.8% gain, but the married put, which guaranteed we wouldn't lose more than 4 or 5%, ended up with that 12.6% gain. So it's a slower profit, and you're not generating premium month by month, but long-term, limiting risk really does help the positions. All right. Well, that's enough about that. It's 15 after, folks. Let's go ahead, and I just wanted to wrap up real quick. Just remind everyone our PowerOptions services, the 20-minute delayed service, gives you access to all the tools in the tool menu. 20-minute delayed quotes is $60 per month. We do offer a real-time service, so every time you refresh the page or run a new search, you're getting the numbers in real time. We did kind of see that today. Remember, we were looking at one of the positions. It showed what was it? I just lost the numbers in my head. I'm sorry. I think we were looking at a possible rollout that was showing a was it a 2.9% gain, but then we linked over the Simulate Trader showing a 3.2% gain. So that was because of the increase in the stock and the increase in the call that we were rolling to. And we do offer a historical suite of tools for backtesting purposes, but that's not available in real-time or 20-minute delayed. That's just available in the real-time and historical upgrade. Next week, of course, and this week, I'm sorry, we're not at the end of this week yet. Thursday at 12 noon, Kurt's going to host the Introduction to Radioactive Trading Techniques. That's at 12 noon. Wednesday at noon, I usually teach the Intro to Power Options. Next week, Wednesday, we're going to be showing the search tool. All right, so this week before expiration, we're showing the portfolio tool, how it can help you manage your positions. Next week, we'll be showing the search tool to find new positions now that we've passed expiration. And, of course, this Friday, 2 days from now, at 4:30 p.m. after the market closes, I always host an open discussion, open forum. I don't have any planned material for the presentation. We just plan on handling our attendees' questions, but if no questions come in, yeah, I'll showcase some of the stuff that I talked to other customers about this week or during a coaching session, for example, or other planned material. Well, ladies and gentlemen, thank you for joining me this afternoon. If you have any questions later on, just go ahead and send me an email to support@poweropt.com. Of course, you can also reach us during market hours. If you live inside the U.S., you can reach us at 877-992-7971. That's toll-free. If you live outside the U.S., you can reach us the international number. That's 302-992-7971. Of course, there's contact links on every Power Options page. Ladies and gentlemen, thank you once again. I hope you have a great week. Happy expiration. I hope to see you soon at one of our upcoming webinars, either tomorrow at 12 noon or Friday at 4:30. Take care, everyone, and we'll see you soon. Oh, and let's see, was it Ellie? Eli? I'm sorry, I'll look into that. Let me just write this down here. I'll send you an email in a little bit. And, sorry, misspelled that. Sorry. There we go. Okay, I'll take a look at that, see if I can find information on your blueprint order, and see where it is. And I'll send you an email sometime this afternoon, probably in a little bit. Okay? All right. Ladies and gentlemen, thank you again. Take care. We'll talk soon.